Welcome learners, welcome to the discussion of capital gains. This week we will be learning section 45 to section 55 of the Income Tax Act, which deals with the head of income, capital gains. When the assessee earns income by way of transfer of a capital asset, then the gains or loss is chargeable under the head capital gains. So, we will devote this session on learning how income tax is charged on capital gains. Section 45 of the Income Tax Act deals with chargeability. Section 45 provides that any profits or gains arising from the transfer of a capital asset effected in the previous year will be chargeable to tax under the head capital gains. Such capital gains will be deemed to be the income of the previous year in which the transfer takes place. So, any profit or gains arising from transfer of a capital asset during the previous year is chargeable to tax under the head capital gains immediately following the assessment year. Now, this will be taxable if such gains is not exempted or not eligible for exemption under sections 54, 54B, 54D, 54EC, 54F, 54G and 54GA. Now, if we analyze section 45, then we will find that there are 5 conditions. Condition number 1, that there should be a capital asset. Condition number 2, the capital asset is transferred by the assessee. Condition number 3, such transfer takes place during the previous year. Condition number 4, any profit or gain arises as a result of transfer. Now, mind it, the term profit or gain also includes negative profit or gain, or in other words, it is loss. And condition number 5, such profit or gain is not exempt under sections 54, 54B, 54D, 54EC, 54F, 54G, 54GA and 54GB. So, if we go again for the 5 conditions which must be fulfilled for any income to come under the head capital gains, we will see number 1, that the important term is capital asset, and second important term is transferred. So, now what is a capital asset? According to section 2 subsection 14, a capital asset means a property of any kind held by an assessee, whether or not connected with his business or profession. Or secondly, any securities held by foreign institutional investors which has invested in such securities in accordance with the SEBI regulation. To make it more clear, capital asset does not include number 1, stock in trade, that is any stock in trade other than the securities which we have already discussed, or consumable stores or raw materials held for the purpose of business or profession of the assessee. And secondly, personal effects. Personal effect, that is to say, movable property, such as including wearing apparel and furniture held for personal use by the assessee or any member of his family dependent on him. But remember, archaeological collections, drawings, paintings, sculpture or any work of art, even if these are personal effects, these will be treated as capital asset, and transfer of such assets will attract capital gains tax. Capital gain asset does not include rural agricultural land, that is agricultural land in India which is not situated in any of the specified area, that is the population of 10,000 or more, or it is in a cantonment board or municipal area. And also capital asset will not include specified gold bonds, 6.5% gold bonds 1977 or 7% gold bonds 1980, national defense gold bonds 1980 issued by central government, special bearer bonds 1991 issued by the central government. And also capital asset will not include gold deposit bonds issued under the gold deposit scheme 1999 or deposit certificate under the gold monetization scheme 2015 notified by central government. Otherwise, all assets will be treated as capital assets. So, repeat, capital asset includes almost all assets, all property, but which is held by the SSC, whether or not connected with business or profession, including securities, but will not include stock in trade, will not include personal effects, will not include rural agricultural land, and will not include specified gold bonds or gold deposit bonds.